Hello and welcome. We shift back towards commodities, and today we'll be talking about Sambhv Steel in today's edition of All About Your Company. Why is this one interesting? Well, you've got one, its capacity going up 3x over the next 4 to 5 years from the current 620,000 metric tons, which they do annually. They're going to increase their capacity to 2 million metric tons per annum. So you're going to see a remarkable shift in terms of capacity. It's a recently listed company, and despite that, it's given a decent return in terms of shareholder returns as well. Currently, it trades at around 25 times. We'll try and understand this a little bit better. Let's try and take a step back, understand the company better. It was incorporated in 2017 in Raipur, Chhattisgarh. It has a market cap of around 3,500 crore at least at this point. And it's a fully integrated steel and structural pipe manufacturer. Of course, not as fully because it does acquire iron ore, but outside of that, from iron ore till pipe manufacturing, they are pretty much integrated. Some changes internally still need to be made. They need to ramp up production on some of the raw material components post iron ore, but nonetheless, they are in that journey with regard to ramp up. In terms of products, let me try and quickly understand and explain those products quickly. You've got sponge iron, which is a refined iron, which is a substitute for steel scrap. But they do manufacture that, which is sponge iron. They do sales, but very little. Priority is given on in-house, forward integration rather than sale of sponge iron. Then there's blooms and slabs, which is the second rung of manufacturing in that pipe manufacturing process, where they have cast steel blocks rolled into coils. They've got hot rolled coils as well, which is a steel rolled coils, which are obviously which are malleable, which are bendable, and therefore they are hot. But the stronger ones are the cold roll coils. Let me go to that one. Cold roll coils are thinner, they're stronger, and they're rolled at room temperature. Hot roll coils are obviously heated in that sense. You've got electric resistance welded black pipes. Now, this is the key product for them, ERW, but they're trying to get into stainless steel, do less of ERW because the margins and realizations there are more difficult to achieve. There's larger competition, and stainless steel, therefore, is a niche product according to them, and therefore the realizations are much better in stainless steel. Also, the product pipe is much better in terms of stainless steel. The other one is galvanized iron pipes, is what they do. Hot dipped zinc pipes for water and plumbing. That's the use case for galvanized iron pipes. Then there's pre-galvanized coil, which is zinc coated and basically feeds into pipes and fabrication and used for further fabrication as well. Then there's pre-galvanized pipes, which is corrosion resistant pipes for structures, solar, telecom, and the like. There's steel door frames, which is termite-proof frames for low-cost housing, which is typically the use case. There's steel blooms and slabs. We come back to blooms and slabs. Corrosion-resistant semi-furnished stainless steel is what this is. Then there's stainless hot-rolled coils as you go up the value chain towards stainless steel, which is the base for annealed and cold-rolled products. There's stainless H-wrap coils, which is cleaned pickled coils for further processing. You've got stainless cold roll coils as well, which is bright surface coils for pipes, utensils, and the like, which is the use case for stainless cold roll coils. And then there's captive power, which is used in the manufacturing process to ensure a lower requirement to source power externally and kind of internally generate power, which should aid margins in the medium term. So these are all the verticals that they are actually further investing in, and predominantly power, of course, is one, but stainless steel is where the large ramp up with regard to capex is likely to play out. In terms of capacity, let me break it down now. They currently have around 624,000 metric tons of capacity, which is MTPA. Stainless steel CR coils should add another 58,000 MT, and debottlenecking of stainless steel CR coils should further ramp up that 58,000 to maybe 126,000, if I recall right. So there is a ramp up at play there. ERW pipes and tubes is likely to get ramped up or or production there is likely to go up to 150,000 MTPA. Then there's stainless steel and MS flat products where, and this is where a large part of the capex is going to happen, 1.2 million metric tons, I beg your pardon, per annum is going to be the capacity there, which should take the total capacity to 2 million metric tons. That's broadly the breakup. There you go, and which is 3x the current capacity which Sambhv Steel has. So you're going to see a very large ramp up in terms of capacity. Let's look at business model now. They buy iron ore to make sponge iron, which is then fed up all the way through the value chain towards stainless steel. So sponge iron is then converted into steel and coils, convert coils into pipes, tubes, coils, frames, and byproducts and waste heat to generate power is broadly the business model which they follow. In terms of geography, sales are largely stuck to India. They're currently selling in 15 states and 1 union territory. The key strong states, of course, are the home state of Chhattisgarh, but outside of that, Maharashtra, Gujarat, Haryana, Rajasthan are also some of the other states which are, crucial for sales. Let me now take you through the financials very quickly. In terms of top line, it's grown at a 37% 3-year CAGR, so you've seen a very strong growth, but that is capacity addition. Realizations have been a little bit difficult to come, and that's why what you've seen is EBITDA growing at a 33% clip and profitability also growing at a 33% clip. So a slower clip on both of those. This is 3-year CAGR, and you can see the 5 to 6 year journey in front of you, which is evident in terms of how the journey has been. Margins, because of realizations, margins have come a little bit under pressure. We've seen a bit of that unwind in Q4, by the way, where margins have come in at 13%. We'll try and understand from management how realizations, margins and product mix is evolving and what is the kind of tailwind we are seeing there. Also, this is something which is important. More important than margin here is EBITDA per ton. Now, crucially, FY26 EBITDA per ton was expected, or rather guided at the start of FY26 to be at 8,000 rupees per ton. Keep that number in mind. 8,000 rupees per ton was the expected EBITDA per ton for FY26, which was guided at the start. Thereafter, the guidance was shifted to 7,000 rupees per ton in terms of EBITDA per ton, and they've achieved that number in around the 7,000 number. But curious to know whether we can maintain that. What has caused the downtick or the downward shift, 12.5% downward shift with regard to EBITDA per ton expectations? We'll try and understand some of those metrics, but that is all part of the margin trajectory, and therefore where should margins lie in the medium term? They're doing around 250 to 270 odd crore of EBITDA, which should further feed into capex. Of course, net of interest costs, they have around 300 crore on the balance sheet as debt as well. Let's in fact pull up the balance sheet, and what you'll see there is around 1,000 crore of equity in the balance sheet, and it's a 3,500 crore market cap company, so 3.5 times book is what it trades at. And then you've got around 370 crore rupees of debt lying there. You also got around 90 crore of cash, so net debt is around 250 crore odd, broadly, ballpark. That's how it is. Let me now look at cash flow, and cash flow conversion is the other piece that we want to focus in on. Conversion was 89 to 90% in FY24. It's come off a little bit. Working capital days have gone up. Now, I've given this a thumbs up, but what you want to understand is whether this will continue to trend downwards, in which case it's there is a concern here. If not, we should be okay from a cash flow standpoint. Also, from a cash flow standpoint, what you want to understand is where is the capex going? How's the debt going to shape up? Because there's such a large amount of capex which is in the pipeline. That's the other piece you want to keep your eye out on. But they're doing so much capex, return ratios, that becomes important. And when we're looking at the return ratios, you've largely seen 15% plus, in fact 20% plus on the return ratio count. 14% in FY25, you saw that 10% margin eating into ROCs, but 14% in a bad year is not bad. The question is, can this be maintained even in a high capex cycle, or will we see a trim down with regard to ROC? We'll understand that better. In terms of shareholding, 56% owned by the promoters, so 50% plus, no concerns there. Decent promoter ownership. That is pre-IPO, post-IPO. We've given you the promoter shareholding dilution which has happened. We've given you the current FIDI holdings as well. And then you've got the balance which is sitting with the public. In terms of valuations, it currently trades at a 24 times approximate price to earnings multiple. Of course, what we also need to see is what the average multiple is. It has traded last 6 months in a range of 18 to 25 times. So this is the higher part of that range. In the 6-month period, it's traded at roughly 21 times in the last 6 months, which is the average. Pre-IPO, it was at 24 times. Post-IPO, it was trading at 45 times post the dilution, but it has quickly come off because of the kind of growth we've seen in terms of profitability. So credit be given, that's how it's played out. Now, let me bring on board Mr. Vikas Kumar Goyal, who's the Managing Director and CEO of Sambhv Steel. But I'm going to bring him on after a very short break. Stay with us here. We need to take that very quick break. Come back, speak to the management of Sambhv Steel. Welcome back, and we're speaking with the management of Sambhv Steel, and we have Vikas Kumar Goyal, who's the Managing Director and CEO, joining us. We've just tried to kind of give a quick brief of the company, Vikas, to our viewers. But let me start off by understanding from you how are realizations shaping up. There was some bit of pressure in Q2, Q3 on realizations. Q4, you've seen a rebound in realizations. In fact, when I've looked at your numbers, realizations stood at around 8,500 for this quarter, which is substantially better. But you've ended the year sub 7,000. What's in store for FY27? Can Q4 realizations be maintained?
Of course, thank you for giving me this opportunity in your channel.
Great having you.
And in 2027, we are looking the volume growth 10 to 15%, and EBITDA per ton between 7,000 to 8,000. Last year, we achieved 7,500 for annual basis, and the Q4 is absolutely good. Because of the HR coil prices is high from the Q3. So I think this HR coil prices is maintained in this year. So we will hoping this year we are in 7,000 to 8,000 EBITDA per ton.
Understood. So 7,500 is on your value-added products, right? EBITDA per ton. On your overall EBITDA per ton is sub 7,000. What do you guide for, Vikas? What should one look at your company with what lens? Should we look at only value-added products? Should we look at overall EBITDA per ton? How should we look at you?
We are excluding only the sponge iron sale, because sponge iron is not we are melting this product. So this is as a kind of raw material. So we are excluding this only this in our product portfolio, and we are just selling 90% of our value-added products. So if we count all the products excluding sponge iron, it will be the 7,500 for the last year, and we are continually hoping with these numbers only.
Understood. So 7 to 8,000 per ton, and you're talking about 15% volume growth also that you'll clock in FY27, right?
Yeah.
And what does that translate in terms of revenue? Because I was trying to locate the mix of your revenue, but I wasn't able to understand that very well. So on the 2,400 crore of revenue that you clock, what's your mix like, to try and help us understand how we should look at your numbers?
Just in the product mix, we have 25% of stainless steel sales in the 2,400 crores, and 75% of the carbon steel, including the coated and the pipe and tubes mix. And if you talk about the 27, it will be the 2,700 to 3,000 crore for the 27.
Understood. So 2,700 to 3,000 crore will be your top line in FY27, which is maybe a 15% jump. So broadly, the same kind of product mix is what you seem to be maintaining, because it's your top line is also going up by the quantum of your volume. Is that the right way to think of it?
Yeah, little bit increase in our utilization is better in the pipe and tubes and coated products. So little bit improvement is there, and we just establishing 58,000 brownfield capex of the stainless steel. So that just from 10 to 15%, we are looking from the same from stainless steel also.
Okay, and what's the risk like of a Q2, Q3, FY26 in terms of realizations translating in FY27 as well? Is that a very real risk in your opinion?
No, no, no too much risk. This year is the monsoon is likely low with the reports of the monsoon. Last year the monsoon gone 6 months larger. So the if the monsoon effect and the HR coils production is little bit abundance and consumption is less from the HR coils. But now in these days the HR coil production and consumption is at par. So we are not looking the HR coil prices is go reduce from the 5 to 10%. So this, the price will be realization will be better for this year.
Okay, so your realizations will largely be maintained is what you're saying. In fact, will be better than FY26. So there's
Yeah.
a positive bias there. Give me a sense, Mr. Goyal, how should one look at your impact of West Asia on your business? Iron ore is something that you consume. What has happened over there in terms of pricing? Power is what you consume. Coal is what you consume. Has pricing spiked? Are you seeing raw material prices go up? And if so, what's the impact overall?
Are you looking with the steel manufacturers are using the coking coal that is the import based, but we are in the secondary steel manufacturing route, so we are using domestic coal in spite of imported coal. So we not dependent on the imports, and for the energy we are 55% to 60% producing our own energy in with the power plants, so that we are also not depending the external sources, and 10% of gas utilization in our plant. So we transfer from January 26 to propane to PNG. The GAIL line is in interrupted supply we are getting.
You're adding 1.2 million tons of stainless steel production starting Q4 FY27. If I've understood this right, this will be a very large supply which is going to come on stream. I have two, three questions with regard to that because that's a key lever which the street is relying on from you. It doubles your revenue potentially, and it also increases your margins because your margins on stainless steel are better than regular. How quickly is the ramp up expected to happen? So your capacity of 1.2 million, which comes on stream, how quickly does it ramp up? Give us a sense.
1.2 million ton capacity is in three phases. We are going to get a setup of the first phase in 27 this year, and will be utilized in the next year. So our revenue is double with the next year with the 3.6 lakh ton capacity of stainless steel from the new unit, new greenfield capex. And also we are setting up pipe and tube unit of 1.5 lakh tons, and our costing reduce the costing, and 30 megawatt power plant also. So the product mix and stainless steel is better for us, but our bread and butter is the pipe and tubes. So we are also increasing the capacity in the pipes and tubes, or for the 1.2 lakh ton million ton capacity, first phase of 0.3 million ton is stainless steel, and the rest is the mix of pipe and tubes, carbon pipes and tubes, and stainless steel both.
How much is the capex, and how quickly does it ramp up? How does it start reflecting on your top line? So your top line goes from say 2850 crore or 2800 crore, if I can take the FY27 top line of 2800 crore. 2400 crore accrues straight in FY28, so you'll add 2400 crore to that top line in FY28?
Yes, we are adding just double from the here in 28 with the utilization of our new capex of pipe and tubes and stainless steel projections.
And will you be at 100%
In
capacity
next
utilization in FY20? Sorry, please go ahead. Please go ahead, Vikas.
In 1.2 million ton capacity and 3 to 4 other products we are planning into 4 to 5 years. With these capacities, we are going to the 2 million ton of capacity of finished product, value-added products. So that we are hoping this very our plan is on the paper, and we are going with that.
Yeah, I mean, you'll have to really execute in a strong fashion, Vikas, and the street will likely bet on that. But give me a sense, therefore. So, at 5,200 crore in terms of top line, will you be at 100% capacity utilization? Will you be at 50? Will you be at 70? What will your capacity utilization be?
Capacity utilization is just if you talk about the 0.36 million ton stainless steel capacity, it's around the first year capacity is the 40% utilization, and the pipe and tube will be 70%, and the coated products will be the 70 to 80% utilization we will get.
When do you go to a full capacity utilization, therefore?
In just next 2 or 3 years.
So by FY29-30, and therefore, how is the trajectory of revenue expected to be for FY29, FY30? Broadly.
It just 4 times to here. If you talk about the revenue, yeah.
Okay. So you go towards maybe 9,000, 9,500 crore in terms of top line. And what happens to EBITDA per ton? Because you'll likely be doing stainless steel and therefore you go up the value chain. What happens to EBITDA per ton for you?
It will be slightly increased to 8,000 to 10,000 rupees per ton. It is depending on the utilization of the new resources.
Understood. Okay. And how quickly does it go? So FY27 will be 8 to 9,000 per ton. Is that what we can pencil in?
27 is 7 to 8,000. 28 is that 8 to 9,000.
Understood. Okay. And sorry, yes, you did mention 7 to 8,000 for FY27. Give me a sense with regard to the capex that you're doing, the quantum of capex, and how do you fund it? Because you're sitting on around 100 crore of cash, you've got around 350 crore of debt sitting in your balance sheet, and you have around 250 to 300 crore of EBITDA margins, which you will make in FY27. How much of capex? How much is internally funded? How much do you fund externally?
We are just targeting 930 crores of the capex with this KESA phase 1 greenfield project, 1.2 million ton phase 1, and the 200 crores for our pipe mill and power plant for the cost efficiency and for the self-sufficient in the cost energy cost. So we are deploying. We are deployed also already 300 crore rupees in this project, and with the 800 crore of term debt and the 200 of working capital debt. It's highest of debt is 27 is 1,000 crores. We are expecting, and we are also maintaining our debt with the net worth of 1.5 over our net worth, and forward EBITDA 1 is to 1.5. This is our plan.
Okay. No, sorry, let me take a step back. So 1,000 crore in terms of debt is where your debt level will go from here. So from the 350 crore, 370 crore currently, debt will go to 1,000 crore, of which 200 crore is working capital debt. Am I right?
Yeah.
And is this FY27 end? So you'll see significant amount of capex happen in FY27 itself. Is that the right way to think of it?
Yes, sir.
And how much is your total capex?
So total capex is 1130 crores as of now.
Okay.
And out of which we are taking 800 rupees total term debt.
Understood. Okay. And how much of internal accrual will you utilize for the purpose of the capex that you are planning to do?
300 to 350 crores will be utilized for the rest amount is the minus. We are now totally debt free after the IPO with the total all loans we are just pay off, and we are just now debt free. So we are taking the just term debt for this expansion only. So if the project cost is 1130 and we are just term debt is 800.
Understood, Vikas.
About 350.
Vikas, got your point. Does your ROC therefore fall in FY27, FY28 maybe? Does it fall below 15%?
We are just achieved ROC 16% and ROE 18% despite of our continued capex, and we are line with it. I hope this will be increased but not decreased in further.
Okay, awesome. Thank you so much for joining us, Vikas. Thank you for coming in and having this conversation. viewers, that's with regard to Sambhv Steel in terms of forward guidance. Out of time on this edition of All About Your Company. Hope it was fruitful for you. Thanks so much for watching. More action on the other side. Stay with us here on ET Now.